If you're a loan officer originating reverse mortgages or thinking about originating reverse mortgages, this tool might be very helpful for you. I built it so that I, as a loan officer, could explain to potential reverse mortgage borrowers, their heirs, their financial planners, tax advisors, anybody that they wish to bring into the conversation, explain to these folks how reverse mortgages work. For me, it acts a little bit like a script. It's just sort of a natural flow of the conversation of reverse mortgages. It gives numbers in a very easy to understand way, both in charts and graphs and actual numbers and tables. It also answers quite a few questions that come up during the conversation. So let's take a look at it, shall we? This is the landing page. It just sort of says, hey, it's a new reverse mortgage calculator. Try some different scenarios, try some different assumptions, and see what your equity looks like in the future, or your cash flow. Some disclaimer verbiage down here and licensing information for the company that I work with right now. Loan officer contact information. We've got an about page here that just says, a little bit of information. What is a reverse mortgage? This particular tool deals with the FHA insured reverse mortgage product. There are proprietary reverse mortgages out there. In many cases, that's the better fit for a potential borrower. But because the vast majority of all reverse mortgages are FHA insured, I felt going with this tool would be a great way to start the conversation with borrowers. You can always segue to a proprietary product if that makes more sense. Different ways people use a reverse mortgage, some FAQs, and loan officer contact information once again. So let's get started, shall we? We're going to ask for a lot of non-personal information. If you go to many different calculators, they'll ask you for a little bit of information, and the results that you'll get will not be really something I would consider to be reliable. Because if they only ask for 2 or 3 data points, how can you rely on that information? We're going for a lot of data points, none of them personal, so you don't have to worry about giving up your address, your social security number, your date of birth, none of that. But we want to be able to pre-qual the clients or the prospects so that if we're showing them numbers, we're quite confident we'll be able to deliver those numbers. So let's go through it, shall we? Let's just say you have a 70-year-old for the youngest borrower, homeowner. They do not have a birthday coming up anytime soon. Estimated property value is $825. And they live in California. They self-report as having excellent credit history. They've got a car loan of $350 a month, and their minimum credit card payments are $125 a month. Their property type is a single family. There's 2 people living in the home, husband and wife. It's not in an HOA community, so no HOA dues. It's 1,850 square feet, and they do not own any other real estate. Now let's look at the income and the assets. Income is $5,500 per month combined. They've got $15,000 in their checking account and $250 in combined IRAs and 401ks, things of that nature. No other assets. Their mortgage balance right now is $125,000. Their monthly payment is $750 per month. There's 26 years left on that mortgage, which means they got it 4 years ago when rates were low. And that $750 has no escrow connection there. There's no payments included of principal and, property taxes and insurance. So the $750 is principal and interest. Annual property taxes, we'll call it $5,000 a year, and their homeowner's insurance $1,800 a year. And there is no HELOC or any other second loan. So now we click on Get Results. And we'll start off with a graph, a chart that kind of gives an estimate of what the future looks like for them in terms of home equity primarily. They've got a lot of equity right now. The blue slice is equity. And they'll continue to have a lot of equity if our assumptions prove to be correct, and we'll go through those assumptions. The green slice is the loan balance. That loan balance starts off at around 125, maybe a little bit more than that to pay off the fees that are incurred in getting a reverse mortgage. And assuming they never make any payments, the loan balance will go up over time. We can model making payments, but if they don't, this is what it looks like. And this yellow line is the line of credit. Similar to a home equity line of credit, with important differences that we'll go through. One important difference is in a home equity line of credit, the draw period ends after 10 years. This one doesn't end. It continues on for as long as you're alive and living in that reverse mortgage home and not in default. In a HELOC, the amount available to you is typically fixed for those 10 years, whereas with an FHA reverse mortgage, the line of credit availability grows over time. Here are where we do the modeling with the different assumptions that we've baked in here that we can now change. And down at the bottom we have a chart that just sort of echoes the above chart, but also says, well, okay, what happens if at 85, for example, that reverse mortgage ceased to exist because I sold my house or the last borrower passed away? Well, your 825 home would be about 1.2 million, or close to 1.3 in 15 years. Your mortgage balance would go up from 125 to 332 because you're not making payments. So we're going to be adding the interest and FHA insurance onto the loan balance. Your equity would go up from 700 to 950, so roughly $250,000 increase. You'd have a cash flow benefit of $135,000. That's because you're not making that $750 a month payment for 15 years. Add the two together and you have a net positive impact. And at age 85, if you wanted to take anything out of your line of credit, you'd have about $441,000 available to you. Down here we just show the cash flow chart. This just shows that you've got no more obligation to make these legacy mortgage payments. And over 15 years, that adds up to the $135,000. So how do we change things? We can consider making voluntary payments on a reverse mortgage. We can receive money from the reverse mortgage. We can change the interest rate and property appreciation rates here. Well, why would anybody make payments on a reverse mortgage? Well, you're paying $750 a month now. Maybe that's a little tight. What if you were to voluntarily pay $500 a month for the next 10 years? Naturally, you're going to see a little change in your loan balance in the future. It went down. We'll put this to 0 again, and then you'll see the difference. See how the green moves? Now the green's going to come down where you're paying $500 a month for 10 years, which means you have a lot more equity in the future. You probably also notice that yellow line going up. That's the line of credit. Every dollar you pay in is applied to the loan balance and also increases your availability in the line of credit. So basically you can redraw this money in the future and it's growing in your favor in the future at the same rate of growth where the loan balance is growing. Okay, so let's leave that alone for now and collapse it. Now let's say you want to receive money from the reverse mortgage. Yeah, I got that car loan. Wouldn't be bad to pay that off at closing. So give me $15,000 at closing. Now if I'm going to be making payments for 10 years, maybe I wouldn't want to receive any until, I don't know, maybe in my mid-80s, in 15 years, when I'm 85 years old. Maybe I might need in-home care for 3 years. How much can I get? Well, you'd be able to get about $15,000 a month for those 3 years if you applied all of your line of credit to that. So let's look at the chart, and I'm going to click on yes. I want all of that money to go into the line of credit, into the monthly payments. You'll see the yellow line go down to 0 because we've taken everything out of the line of credit in order to fund those 3 years of payments of $15,500. Your loan balance is going up. Anytime a bank gives you money, that means you're borrowing from the bank. That means your loan balance goes up. So here you've had considerable amount of money coming to you. That's a big increase in your loan balance. So you'll have less equity in the future up here if you go this route. Now let's say you say, you know what, I'm really uncomfortable with that much of a loan balance and that amount of equity. All right, why don't we drop this down? Let's say no, you don't want the max. How would it look if you were to get by with, say, $8,000 a month? At $8,000 a month, things change, of course. You still see a drop in the line of credit. We're taking money out of the line of credit to fund the 3 years, but there's still a lot left and a lot more equity. So you can kind of play with this till you find sort of a sweet spot, so to speak. We're going to collapse that and leave that alone. And now interest rates and property value appreciation rate. We default to the historic average of this, what the interest rates for this product has been in the past. This is an adjustable rate loan, and this represents the actual 1-year treasury rate plus the margin for the lender plus 0.5% for FHA and where that's been over time. We take the average of those 35 years or so and we plot that right here, just assuming it continues flat in the future. And that's how these numbers are calculated for the growth rate in the line of credit and the loan balance. What happens if we change that? Let's say we say, okay, what's this Twin Peaks? Let's take a look at that. Twin Peaks changes the expectation for future interest rates. It's not scientific, it just says rates go up and down in the past, so maybe they'll go up and down in the future. This is, on average, a higher rate than what we just looked at. That means we're going to see a higher amount in the loan balance in the future and a higher amount in the line of credit in the future. Trying to remember what this chart looks like here, and I'm going to change it back to the average rate, and we're going to scroll back down and you see the chart change. A little more equity here because the historic average is a little bit lower than that aggressive Twin Peaks. And the last one to look at is the property value appreciation rate. We default to 3%. If you happen to live in a neighborhood where you feel like 4% is a little bit more realistic, then we change it to 4%, and that has a major impact on future equity. If you want to be even more conservative and drop it down to 2%, you can look at that, and you'll see that have a significant negative impact on future equity. There's still quite a bit. How much is there? Well, let's look at age 90, shall we? Click this up to 90. And at age 90, there'd be a little over $500,000 of equity. So you'll have lost some of the equity that you've had over those 20 years, but still a decent amount for the heirs. A significant positive cash flow impact. Add the two together and you have a net total positive impact of about $260,000. And you still have, at age 90, $500,000 available to you in the line of credit. Quick review of our cash flow chart down here. Red is negative cash flow. That's because you paid us for 10 years. Green is money going to you. That's that upfront payment to pay off the car loan. And then after age 85, you started receiving monthly payments from us. And this is the legacy. If this had been set up with property tax and insurance payments being done by the reverse mortgage, then you'd see that cash flow benefit here. And the way to do that is over here on self-reported credit, just drop to below average. If a prospective reverse mortgage borrower does not have a good enough credit history to pass FHA standards, they can still get a reverse mortgage, but there will be an impound account or our version of an impound account to pay property taxes and insurance on their behalf with reverse mortgage money over a number of years. Similarly, if they don't have enough income to qualify, a similar option might be available to them. So let's go back to the results page here, and you'll see some changes. The line of credit is not as high as it was before. It's not growing as fast, and that's because of this property tax insurance reserve. We've held back some money in order to make those payments in the future. You still have your same options available to you had before. Let's say just redo it, $750 a month for 10 years is your voluntary payments. How does that change things? A lot more equity. You want to receive, I think it was $15,000 to pay off the car loan here. And then in 15 years, you want to receive money from the reverse mortgage for a period of 3 years. In this case, you're not going to be able to get the $15,000. It's closer to $12,000. If you say no, I want my $7,500, for example, drop that in there. You'll see things change considerably. And the interest rate scenario, we went with the average. You can do your own custom if you want to. Might want to go with the initial interest rate where we are right now and just assume that that stays flat over time. And maybe you go to a 4% property value appreciation rate. And we look and see how those changes affect. You haven't heard me use any specific reverse mortgage terminology. And I think that these numbers in these charts really make it relatively easy to understand the flexibility you have with a reverse mortgage. Let's just say you pick that 3-year horizon here for receiving money, and 1 year into it you decide you want to change your mind. Not a problem. We can stop those final 2 years so you won't receive the money, and whatever we still have in that reserve account will go back into the line of credit. So it's a very flexible process. These are great for most people. Some people want to see the actual numbers. They show up here in certain tables. This is the cash flow that we use to build those charts. And here is the amortization schedule used to estimate the future equity, which is property value minus loan balance, growth in the line of credit, and these are all influenced by whatever payments are being made, and the interest rate scenario. There's also a bit of verbiage up here to help people understand what are the cash flow benefits, how do they work. This line of credit is actually quite unusual. I'm not familiar with it. Tell me more. The annuity style payments, wow, this is really kind of very strong because it's similar to the annuity style payments with an insurance company, but much more flexible. As I mentioned before, you can start and stop them at your leisure and without major penalties. Making a change is about $20 at the current rate every time you make a change to something like that. Very manageable. The great benefit you get from voluntary payments going from the borrower into that line of credit, as you saw from the modeling, the rate of growth at the moment is about 6% per year, compounded monthly, and that's the same for the loan balance and the line of credit. I mean, where else you can get 6% insured by the U.S. government? And other facts that are important for people to understand: there's no personal responsibility to repay the loan. You can keep the home in a trust. It'll definitely be in your name or in your trust name. And other important things for people to understand. And you as a loan officer can kind of go through this, once again, sort of as a script format. Here's the fees. Fees are higher on a reverse mortgage than they are on a 30-year fixed. And everybody has to decide whether these higher fees, which are financed, are worth it for the flexibility and being able to really take control of your mortgage in the future and not let it be run by a big bank. The only out-of-pocket fees are typically for counseling, and that's $150 to $200. Everything ready good? Cool. Take my next steps. If they're ready to go, capture their personal information on this page. If they're not quite ready yet, you can download a PDF of what was just built for them. Both this and this will show up in your loan officer dashboard, so you'll be able to track everything that's being done on your site. That's most of what these features and benefits are. The other thing is that you can give this unique link for you to your financial planners. The financial planners then can go and run these numbers on their own for their own clients. They don't have to send you an email. They don't have to text you. They can go in here and put whatever numbers they want to. Put the modeling in there. If they feel like it makes sense for their client, then they can, at this next step, put in their client's information. Maybe they're visiting with their client and the client says, yeah, let's go. If an email address comes in here, it might be the planners, it might be the clients, then the system will send a quick email to that email address saying, please confirm we have the correct email address. We want to make sure that they didn't type in the wrong email address or send a bogus one or something like that. When they confirm that we have the right email address, then you know that this information is solid, and you can go ahead and call them up or send them an email and set up a time for a meeting and go through it. We've got a little verbiage here from the compliance department to make sure everybody understands these are estimates only. We have no idea what the property value is really going to be in the future, and we have no idea what interest rates are going to be in the future. and here's the licensing information. There it is in a nutshell. I'll just leave you with this. There's also a smartphone app. This can sit on your phone or it can sit on your laptop. With just 4 data points, we can get estimates. 128,000 in this scenario would be left over after paying off their current loan balance. Click on share, put in the borrower's name and their email address. They get that same short email saying please confirm. That shows up on your dashboard. You contact them and off you go. So I hope this, in conclusion of this long video, shows to you that this is an alternative, a very strong alternative, to the typical comparison page, amortization schedule, and talc that loan officers have been using for years to try and explain benefits and procedures and how the whole thing works in language that is very restrictive because it's so many jargon and terminology that is unique to the reverse mortgage world. Whereas with this system, we're avoiding all that. We're just using plain English and having a simple, easy conversation.